Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope you are doing well. You know, the best part about the stock markets are that every person putting his money in the market has a view, and for every view there is a contradictory view. After all, one man's food is another man's poison in the market. For every buyer there is a seller. You know, I am sure you must be aware that these days the so-called Coffecan investing is the new fad. Certain set of people in the markets are so obsessed with companies with astronomical valuations that higher the price to earnings multiple, the more these stocks are preferred. On a lighter note, the price to book multiples of these coffee can companies are the price to earnings multiples of most of the stocks which me and my colleagues track. Well, such is the overvaluation. A price to earnings ratio of 60, 70, 80 or even 100 has become very normal for these coffee can investors. Well, their argument is as long as there is growth and free cash flow, the markets would give it a higher multiple. The problem is when there is a slight blip in growth, the stocks get hammered down. Buying companies at such high multiples results in a big drawdown even if the slightest of disappointments is felt in the market. I am sure you must have seen what happened to stocks like HDFC Life, Jubilant Foods and DMart, to name a few. Every bull market, there are stories and narratives which are sold to justify these steep valuations. Also, if you look at these coffee can companies, these richly valued companies, all of them are brilliant companies. Most of them are market leaders which have the best financials. Nobody is debating that, but after all, everything in life has a price. Let's say I sell you this iPhone for 2 lakh rupees. Will you buy it? Obviously no. The reason you won't even think twice is because you are getting a new brand iPhone for 60,000 rupees. The problem is you know the price because it is a uniform and Apple displays its price everywhere. Unfortunately, the price of stocks are based on future assumptions of growth and profit of the company. No one knows the actual true price, but that's the most interesting part, as buyers and sellers will debate about the price based on their assumptions. While you can't pinpoint a specific value of a stock, but I am sure investors should understand stocks that are overpriced and underpriced in the short term. After all, you bargain so much in a vegetable shop or at Fashion Street, then why not know what should be the fair value at Dalal Street? In the end, margin of safety is nothing but protection from the downside as valuations are in your favor. Let me explain this thing by an example. Balaji Amines is a company which manufactures alphatic amines and its derivatives, which are used in the pharmaceutical industry. It is amongst the two major manufacturers of amines in India. Now let us look at the interesting part. That is the company's performance, which has been brilliant over the past 3 to 4 years. This is evident from the sales, operating profit and margins of the company. However, in stock markets, the re-rating of stock happens much before the numbers. So, if you look at the PE multiple of Balaji Amines, it has gone up from a 5-year average multiple of 14 times to a 40 times multiple during the peak. I completely agree that the re-rating from a single digit P multiple to mid-teens, which is say 18 or maximum 20, is desired, seeing the massive improvement in business. But tell me, how can you give a B2B chemical company 40 times multiple? Come on, Godrej Consumer or any mid-size FMCG company should be getting that multiple. Is Balaji Amines a brand to get such high multiples? And mind you, the chemical sector dynamics are dependent on global and China commodity pricing. Also, if you look at the revenue growth and margin expansion, The best days were post-COVID when chemical prices shot up and operating margins went up to 28 to 30% for a limited period. Mind you, the average margins are 20 to 23% for the company. Now it is really difficult to continue such superlative performance for the B2B company which sells a commodity whose pricing is determined by global factors. And now for all those people narrating stories like China plus one, re-rating of the chemical sector, and some even calling chemical sector as the next FMCG, imagine if you have entered the stock at a PE of 35 to 40. Over the past 6 months, the stock has corrected by 40% on account of the valuation froth. I mean, at 40, everything is priced in. The last 2 quarter results have been just about average. This was an example of how the concept of average P works and how froth should be identified. So now let us look at another example, which is Jubilant Foods, where valuations have always been high. We all love Domino's Pizza, isn't it? The only thing I don't like about Domino's Pizza is the valuation at which it trades. I agree these mega brands deserve very high multiples. But there should be some parameter to judge the froth in the stock. After all, in FMCG and consumer durable stocks, which are less cyclical and more stable, measuring them on absolute P basis is extremely difficult. How do you make sense of Jubilant Foods, which is at its peak traded at more than 150 times? For FMCG, you should look at price bands. So if you look at Jubilant Foods, it was trading at nearly 3 standard deviations at above its mean during the peak price of 4,500. Unless you are expecting earnings to keep on doubling, there is no way a company can sustain these valuations. Let's look at the numbers of Jubilant Foods. Sales over the past 5 years have grown by say 6 to 7%. Even if you remove the anomaly of a few quarters of COVID, sales growth is subpar for the valuations at which it enjoys. Also, the benefit which Jubilant Food had during COVID when dine-in was shut is no longer available as restaurants have opened and back in action. Well, profit growth for Jubilant Foods over the past 5 years is at an average of only 18%. I really fail to understand how can you pay a triple-digit PE for a stock with 20% return on equity. Domino's core strength is delivery and eat-at-home pizzas. However, over the past 2 years, they are getting into opening a store of Chinese restaurants, which is definitely capital intensive. If the tier 2 and tier 3 towns are under-penetrated, why do you want to try different cuisines like say a biryani or a Chinese? I don't see any synergy there. Anyways, let's focus on the valuations. A company at a 3 standard deviation above its mean was always a potential valuation danger in the making. And the script played exactly that way. Jubilant Food has corrected by 40% from the peak. So, the above 2 examples was just to let you know about how valuations need to be respected. And the best quality stocks bought at the wrong price can definitely trouble you. Now, a lot of stocks in the chemical and FMCG sectors have corrected from their peaks. The question is, do they become attractive at these valuations? Well, in my view, stocks in every sector have a general band. For chemical stocks, there is no way you can pay more than a PE ratio of 25 to 27 times, unless obviously if it's a small cap company and earnings are expected to double. For an FMCG, what has to be seen is the valuation band and not the absolute valuation multiple. For large FMCG companies, anything above 2 standard deviation is expensive. Also, for the FMCG sector, you cannot buy stocks when interest rates are expected to rise during the burning inflation. While I'll agree that stocks like say HUL, Britannia and Jubilant Foods have corrected quite a bit, but in my view, let's wait for some more time before you start buying them. Let all the headwinds get priced in the stocks. You should also appreciate the fact that even if FMCG stocks do not fall further, we still have a problem if they don't rise. There could be a possibility of stagnating returns by these FMCG companies. In that case, we are better off avoiding such high multiple stocks. So guys, this was about the valuation froth in the chemical and the FMCG sector. I hope you guys liked the video and please do feel free to write to me. Thank you.